Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with John Bailey of the Side by Side Partnership to talk about their venture fund. Hello, John.
Alex.
First off, tell me about Side by Side and give me a sort of history about your own background.
So Side by Side grew out of the experience I had in the States in the 90s. I moved a startup company to America seeking capital, which was a bold move. But it was at the emerging time of venture capitalists. And what I was lucky enough to experience was how venture capital, when it was matched with the right skill sets, was really an incredible help to a struggling entrepreneur, which I was for the next 30 years. And at the end of the day, I think that what I was able to experience was mostly because there were no things like preferences or liquidation preferences or preferential shares. We were all on the same table, and we were all, they were a few years ahead of me in experience. They were a constant round of exposure for me to things that if I didn't have to learn it, they could help me. My learning curve would be shorter and sharper. So in summary, we tried to do the same thing with Side by Side. Moved to the UK 5 years ago now. Spent 3 years trying to get to know the market. It's quite different. And then 2 years ago set up this fund specifically organized and structured so that we can maximize the interests of both the investors and the entrepreneurs, because we all sit on the same side of the table, no preferences, all looking after the same goal, which is a long-term goal to grow substantial businesses.
Before we talk about the fund in more detail, can you just tell me about how successful actually this company you founded was?
That turned out to be a good idea. It was formed with ICI, their pharmaceutical division, and it was to solve the problem of remote salespeople being uncoordinated between their data and the head office plans for the territories. So we invented what was called Salesforce Automation. It became known as CRM. We then got involved in what became known as big data. And over the years, we transformed the way the process of selling and the relationship between the company, the salesman, and the customer was optimized. So that company went on for quite a while. We were in 52 countries ultimately. We were sold for 780 or so million, public for 15 years. The whole time there, I was also doing a lot of private investing, and both in funds and directly in companies. Because the experience of running the big business was so diverse, it really set me up well with both a personal and also the contacts to help other entrepreneurs who are trying to do the same thing. So it turned out to sort of be a life mission, although it was really originally very focused on applying software to a very ordinary business problem.
And Side by Side Ventures, then, what sort of businesses you were looking for and what are you aiming to give investors?
Investors, I've been wearing both hats for such a long time now. I really fervently believe that this is like a three-legged stool. You can't have the interests of the entrepreneur or the investors or the clients, the customers. You can't have one of those out of balance in building a long-term strong business. So we wrap the investors into the whole transaction. We share with them a lot of the transactional data. We like them to get involved in what they're buying, and that was a great part of EIS because they actually become equity holders. And we like investors to get a sense of their participation in creating a growing entity. The companies we look for, they've got 1 to 5 million in revenue. They've got 30 or 40 employees. They're real businesses. They're through that sort of risky startup stage that is where all the fun and excitement is. And they're down to the stage where the entrepreneur is starting to build a real business with real departments, customer service departments. The CFO can't be their cousin. They're building real businesses. And of course, it's a skill set most entrepreneurs haven't got. They learn it on the job. And that's what we try and add to, because if we can help the entrepreneur just because we've been there, not because we're particularly smart, but we've just been there lots of times. And we're always engaged at the operating level, how to handle a people problem or a strategy problem or a pricing or a manufacturing problem, the very practical stuff of growing a business. So if we could do that, then I'm hopeful that Side by Side will do for the investors what happened for me when we started Dendrite back in the 90s.
And how many companies would investors get access to if they give you their money?
So I think that we'll probably not do more than 10 or 12 companies. And I realize that means a concentration, but companies come and go, of course. They get to a certain size and we exit them. And we try to make sure that we've always got enough time to put into the businesses that we've brought on board. There's no good promising them something and then not delivering. No one's going to be happy. My three-legged stool will be very uneven. And what we're trying to do always is to maximize the safety of the business as an investment, because I'm highly, highly concerned about that issue. And the other reality that if we go too far, we end up with businesses that don't get enough of our time and maybe they sell too soon, which for me is one of the great fears.
And where do you get all these deals from?
I don't know why an entrepreneur would choose us. I mean, we have got to be the hardest money to work for. We don't give them millions of pounds. We give them a little bit of money, and then we get a business plan built together. And then we give them the working capital that the business plan calls for. And then we hold them accountable for that, and then give them some more money. We work with a structured board from day one. There's lots of ways that VCs work, obviously, but for us, when businesses are going through so many changes as these guys are, being close to them and making sure we've got their attention. You know, there's nothing more difficult to get it than the attention of an entrepreneur, but holding the purse strings does help. And every year they're accountable, they get more money, but of course they also talk to the investors at that point. Every year they talk to the investors. It's a very important part of being accountable as an entrepreneur to the people who made it possible.
Do you want to talk about some of the recent investments you've made?
So we've had some interesting ones. We moved to the UK because I thought there's always been innovation here, and that EIS would ensure that there was now capital and that there would be more companies that reach this level of maturity. And sure enough, there have been, and there have been some terrific ones. So one of them I love to talk about is a company called ShotScope. It's based in Scotland, and they produce a golf watch. Now, I'm not a golfer, but I do know a good idea. And this is a market with one big player in it. These guys have fabulous technology. They have a brand new product that they've been working on for years. It has clear advantages in the competitive evaluation. But mostly I'm interested in what the new technology can do to an old problem. The old problem is that a manufacturer and the customer are disintermediated. Manufacturers don't know really what the customer does, what other clubs they've got, etc., etc. But this company produces data for every single swing that a golfer takes. They know how far the ball goes. They know if the person hooks or slices or whatever with any particular club. And so they build up this whole picture of a person's golf. Now, for the individual player, that's great. It can help them build a better game. I think the answer is in data, because giving that data in a refined form back to help manufacturers build better product, more specific product to individual characteristics. You've now got, you see a picture where the person knows more about the analytics of their game, and so they could make a more informed choice. I equate informed choices with expensive. And so I think this company is going to be at the forefront of that. I love them. They've just launched a new product. They've done last year's revenue in a month. They're flying. Another company I think is really interesting. It's called Laundry Heap. Remarkably, it's to do with getting your laundry done, and they're just really smart. So they do their logistics in India because they do one-night turnaround. They don't have drivers and vans. They subcontract people who are already subcontractors to other companies that need couriers. And they don't build laundry facilities. They take existing ones and add their shift to an existing capacity. So they can expand without capital. This is a fantastic return on capital employed, as you could imagine. And what they've done that's really, really clever, that I think makes a big difference to the viability of the business and its ability to grow quickly and be responsive, is because they're not burdened by the capital and because they've put all their logistics in India, so that at the time that you need maximized logistics moving these vans around at night, that's daytime in India, so their operating costs are low. They've now sprung into accommodation. They're talking to budget hotels. They were just about to do a big rollout before COVID came in and changed their lives. I think they're going to be one of these invisible companies. You won't read about them on the front page of the Telegraph, but they're really transforming the way people do laundry of all things. Last month, even post-COVID, last month was their biggest month ever. So these guys are flying 3-4 million, I think they'll do this year in revenue. We've got one that we have not yet announced. We're closing on the diligence right now. They are digitalizing infrastructure. And this is, again, it's sort of a little bit like Laundry Heap, because no one really thinks about this. But if you've got lots of buildings with lots of equipment all over the place, you've got lots of vendors who are looking after it. So your facilities management bill is usually quite a lot. These guys have used a really clever IP-protected series of sensors and programming that allows them to rationalize the costs of these remote sites. And if you're a big company with lots of these remote sites, I learned for the first time, and funny what you learn in this business, there's a penalty if a train doesn't stop at a platform that it's supposed to, if the lights aren't on. It's 10 grand. I didn't know that. I do now. It certainly helps price the services that we provide. We're going to change them into a software company with services tacked on instead of a hardware business. I think they're going to be fantastic.
So let's talk about COVID. How's it affected your companies?
So this is my third drama, like major drama in business. So there's a couple of rules, and of course it sounds all very old hat these days because I think everybody's now said it. But on the 16th of March, I called up each of the CEOs and said, look, you've got to get through a year. Whatever money you have in the bank today, and that was between 1 and 3 million for them, you have to have enough money so that your burn rate will get you to a year from today. And they each did that, and then exactly the opposite of everyone normally doing. I said to these entrepreneurs, please do not concentrate your efforts. Please look for opportunistic revenue. You know, that's nirvana to an entrepreneur, being told to go out and get creative. Each of them did that. So all three of the bigger investments that we were involved with at that point, all three of them now have done really very, very well. I'm very pleased for them. One of them has just surpassed last year's sales. The second one is going to double last year's sales. And the third one is going to beat their plan for this year, pre-COVID. They've all hired new people. The opportunistic revenue in one case is actually going to turn into mainstream revenue as it happens. And in each of these cases, they've been able to sustain their position in their market when their competitors are not doing so well. So the laundry business is now cleaned up. Now, if you Google something like, pick up my laundry, there's far few companies that are doing that. And that, I think, is important because when they emerge from this, there's going to be buying opportunities and merger opportunities. Really good companies are going to become available. And I want these guys to be able to sort of take that, shorten their own growth curve by picking up some really good competitive business for the right price.
How long do you expect to hold these businesses and for investors to get a return?
Alex, that's the hardest question. I've done 13 exits in 10 years, so I'm not scared of exiting. But one of them, for example, I held for 9 years. We did sell it for 156 million. So that was okay. But we said no at 15, at 25, at 50, again at 100. And so we had a plan and the company was executing to the plan. We got the shareholders in the fund the investors in the fund to extend the fund so that we could do this. And we just then spent 2 years helping the company position themselves for a great takeout. Not all of them end up quite like that, but it would be a failure in my view to have a fund that something comes up and we sell out for 1.5 times in 3 months. We've wasted an awful lot of resource. an awful lot of time, and although there's no such thing as a bad profit, I'm looking for 3, 4s. I don't want to do 1.5s, and that one means that we're probably about 5 years on average, and at the most, it won't go longer than that famous one there. But of that one, it was a bit more tolerable because in the last 2 years, all the shareholders knew that we were getting ready to sell, so it sort of sweetened the deal a bit.
Obviously, the fund itself is new, so I'm assuming you haven't had any exits from that.
Not yet.
No. So, what similar exits have you had exits in a similar sort of field?
Yes. So the company I was talking about was a pure software company. I was just an investor and helping people with their money on that one. But there's another one that we have that is very similar, which is that company I described as being the digitalizing of the infrastructure, IoT. I had one of those previously, a company called Systech. It had 30 years old, 18 million in sales. 5 years later, we had it at 73 million in sales. We sold that at 165 million. For, I think, 5 years, we're in that one. And I look for those patterns because in that one, we created value out of the business by turning it into a software business, changing the way it was pitched, priced, and rather than SaaS, we made it proprietary and we made the perpetual licenses. And so the thing generated a lot of money and therefore we got a lot of money for it.
You've obviously been very successful in what you've done in the past. And
you want to talk about the failures?
I will actually, but my first question was, you probably don't need to bother, so why do you?
I retired at 53. That was an exercise in not understanding me. By 55, I was back and looking at a lot more investments. I've done about 40 companies now, 9 of them here. But the reality, there are two parts of that question, and I think that other people who've been lucky would probably tell you much the same thing. The first is that when you're investing your own money and you make a mistake, it's a mistake. Just, go on. When you've got OPM, other people's money, oh my God, it's much more focusing. So I formed this fund because I want to do again, as I said, what we had tried to do so successfully, or what we'd experienced so successfully in our own business. And I want to do it here because I think there's a tremendous opportunity to forge what future funds look like. I don't think that I'm an altruist. I think most people would tell you that's not true. But I'm a one trick pony. This is what I do. I build businesses. I help entrepreneurs. There's nothing better than the pint of adrenaline you get when one of your ideas has been adopted by a company and it's turned out to be a great idea. It's great for everybody, and I've just been really fortunate. I've been in so many different businesses and things. I've picked up a lot of information and a lot of experience in different areas, so it gives me a lot of places where I can apply it. And then I'm pulling around me the people that I've had in the businesses before, who've got individual different strengths, and each of them could have retired, and none of them did. They all went on. It's one of those things. Just because you could doesn't mean you should.
Is it just you in the company? How big is your team? And
so we're still small. We're 4 or 5 people now. We've got 1 people dedicated to sales, and he's our EIS expert, and we lean heavily on him to introduce the things that we do that are different to investors who are looking to make an investment. Yes, you get the tax deductions, all that's wonderful, but I treat every investment seriously like it's an investment. The tax is just a government subsidy. It doesn't exonerate me from having to return great returns. So he's great because he's got credibility in EIS, and he's really good at bridging the difference between what we try to do and perhaps what's normal in a tax-driven society. The guys that I'm bringing in operations are really an eclectic group, but one of them, I bought 2 companies from him so far. The last one was 23 million. He's been incredibly good in software And so I use him in a couple of our companies where you might imagine that the shot scope is going to need some software help. So Shelley comes in and does that work. We have a really, really good couple of analysts, and then I've got a young man who's been with me since the startup, who's a treasurer, a guy named Ben. He's the guy that keeps all of the companies day-to-day engaged and makes sure that the details of what they're doing doesn't drop off the sort of the notice board. There's just a lot of stuff that goes on in these businesses, and we don't get in to run them. We're not interested in doing that. But we do want to make sure we don't leave them thinking that we're not engaged with them. So Ben does all of that work for us, as well as helping with investors and the FCA.
Very interesting. And failures?
If you're a philosopher, you'd say that's where you learn the biggest lessons. So the big failures, I underestimated the desire to opt out early. I have been defrauded, my money, luckily. I've also learnt that the spirit of the entrepreneur, which we dearly love, can be a challenge. So the reason that the reason we distribute funds for each business plan is that I've had a couple of cases where the entrepreneur will tell you anything, get the money and disappear. So that's not a good idea. We've also had problems in the past where I've thought of something's a great idea and I've convinced myself it's a great idea, and there weren't any customers for it, so it wasn't a good idea. So there's a lot of those sort of, I guess, classic learnings. It really distills in the simple thing. It's about the person. At the end of the day, give me a great entrepreneur before a great product, because a good product and a great entrepreneur will have a fantastic result. And so looking for that right person that's really trying to do something special is very, very rewarding.
To summarise then, if I want to invest in your EIS this year, why should I, compared with others?
So we won't be your only EIS investment. Typically, there'll be people, over the years, you probably put money into there's lots of creative and good funds. There's the spontaneous, creation of business that the SEIS and the early EIS market. We're the counterbalance. In the same way that our companies came through COVID, touch wood, came through COVID. At this stage, our companies have come through COVID, and we've got businesses that are prospering and are going to come out of this really strong. There'll be a lot of young ones that just didn't make it, didn't have the capital, didn't have the management, maybe not the guidance. But there'll be some that come out of there that are spectacular, rocket ships. So typically, we're the counterbalance to that. We're the ones that settle in for a 3, 4, 5 times return, that are solid businesses where we don't buy them unless the clients have already said that the customer said, this is a technology or an advancement that I support. And with that, we know we've got a real company and a real business. They're the ones that are going to be solid growth businesses that we will we will form into a business that a large corporation wants to buy. Most of the trick in this part of the market is to get the company ready so that the company that buys them feels confident. It's well structured, it's well governanced, it's well organized, it's got all of the bits and pieces bigger companies look for. You get a premium from a buyer for that. And so we look to try and do all of those things and produce a real business so that we get a premium price for it for our investors. So it's a balance to what you've already got. I hope the bigger part.
John Bailey, that was really interesting. John Bailey of Side by Side Partnership, thank you very much.
Thank you, Alex.